gross income. So this is my first time doing the presentation, so I'm very uncomfortable to do that. So I'm gonna start it. So my summary that I will go over is gonna be cash method of accounting, taxability components of gross income, interest income, dividends, taxation of dividends, state and local tax refunds, unemployment compensation, social security benefits, and the other income. Cash method of accounting is a method for recording transactions. Transactions are only recorded when cash changes hands. It is recorded only when cash is received. Expenses are recorded only cash is paid. So, under this method, it doesn't matter in which month you did the work for your client or you send an invoice to your customer. The only thing that matters is even they actually paid you. Same thing for expenses. Even when you purchase all kind of stuff on credit for your business, it won't show in your income statement until you pay for it. One of the receipts of the income, constructive receipt of income. So we have no receipt, no tax due. It's going to be funds held in qualified escrow or trust, fund held by qualified intermediary, funds reinvested via 1031 exchange. And to talk about constructive receipts, must pay taxes now. Check received but not deposited. Property sale funds held by disqualified person. And there is one more type of actual receipts does not determine when taxes are due. Checks deposited, funds directly available. What's constructive receipts of income? Income, although not actually reduced to a taxpayer's possessions, is constructively received by him in the taxable year during which it is credited to his account, set apart for him, or otherwise made available so that he may draw upon it any time, or so that he could have drawn upon it during the taxable year if notice of intention to withdraw had been given. However, income is not constructively received. The taxpayer control of its receipts is subject to substantial limitations or restrictions. Example: client mails a check to Sue which she receives via U.S. mail on January 4. The memo on the check reads, "For December services." Is this income in December or January? Correct. Doesn't matter when the services were done. Actually, when the constructive receipt was received. The answer is going to be January. Interest income. Interest income is the amount of interest that has been earned during a specific time period. It is earned from investments that pay interest, such as in a savings account or a certificate of deposit. It is not the same as a dividend, which is paid to the holders of a company's common stock or preferred stock, and which represents a distribution of the issuing company's retained earnings. Also, the penalties paid by customers on overdue accounts receivable may be considered interest income. These institutions report interest income to taxpayers on Form 1099 INT. Interest on savings bonds is taxed at federal level but not at the state or local levels for income. Bonds typically earn interest, which is the amount that a bond can be redeemed for above its face value. The face value is the bond's original purchase price. The interest on savings bonds is also subject to federal gift, estate, and excise taxes. On the state level, the tax on the interest applies for estate or inheritances. Example: Sebastian has received a 1099 from his financial institution showing $167 in the box 2 of the form. How should he handle this on his 2021 tax return? This 167 can be deducted as for adjusted gross income or above the line deduction on her form 1040. The $167 in box 2 of CPSS State 99 ID represents an early withdrawal penalty relating to a financial instrument. I hope makes sense. I'm going to talk over dividends. The most common dividends are the distributions on profit that a corporation pays to its shareholders. Dividends are most frequently distributed as cash, but they may also come in the form of stocks, stock options, debt payments, property, or even services. This type of income is usually reported on Form 1099 DIV to the IRS and you. You will typically receive this form if you receive dividends totaling $10 or more during a tax year. The form reports dividends from a given financial institution, any applicable capital gain distributions, and taxes withheld, if any. Payments from mutual funds may also be dividends. A mutual fund is an investment company that buys and sells assets to earn profit for itself and its investors. The portions of the profit paid on the investors are dividends, unless the assets were held long enough for the profits to be considered capital gain. These are types of dividends. Ordinary dividends are taxed at ordinary income rates. Qualified dividends are made from the earnings and profits of the peer corporation and are from domestic corporation or qualified foreign corporations. Below are the tax rates, how they are calculated. Taxation of dividends. Like other earnings and realized gains on investments, dividend income is taxable. The tax rate on dividends, however, is dependent on a number of factors, including your taxable income, the type of dividend, and the kind of account that holds the investments. This means that the amount of tax that you owe in dividends can vary. If you purchase in a corporation or invest in a mutual fund that periodically pays dividends, the payments you receive throughout the year can provide you with some extra income. Though you must always report the dividend income on your tax return, it doesn't always mean you will pay tax on it, and to report them on the Form 1099 DIV. State and local tax refunds. If you receive a refund of state or local income taxes from last year's tax return, you may receive a Form 1099-G reporting these refunds as income. If you itemize the deduction on a federal return in the same year that you receive the state or local refund, the refund may be considered taxable income. Don't report any of the refunds as income if you didn't itemize your deduction on a federal tax return for the tax year that generated a refund. If you took a deduction in a earlier year for taxes paid that were late refunded, you may have to include all or part of the refund as income on a tax return. Unemployment compensation. Government pays unemployed individuals until they get another job. Only if they lose job without their fault on their own, and the reason is layoffs of replacement. Unemployment compensation is the financial assistance that states offers to individuals who suddenly lose their jobs due to layoffs or other crises. It attempts to ensure that employed workers and staff members have a source of income until they get another job to earn their living. Unemployment compensation, including special unemployment compensation authorized under the Coronavirus Aid, Relief, and Economic Security Act, must generally be included in gross income. If you are receiving employment benefits, the benefits are taxable. Another income social security benefits. Some people have to pay federal income taxes on their social security benefits. This usually happens if you have other substantial income such as wages, self-employment, interest, dividends, and other taxable income that must be reported on your tax return. In addition to their benefits, you'll pay 85% of your social security benefits based on Internal Revenue Services. Goods earnings other than wages or income from self-employment, income, investments, foreign income, and cancel tax. Other income must be reported on Schedule 1 of Form 1040 and it's taxable. You typically have to report other income if you receive money for goods that aren't included on a W-2 or most 1099s. Think prices, awards, jury duty pay, and jury winnings. Conclusion. With the above discussion, one thing must be clear to you, to us, that tax is always applicable on the total income of the assessee, calculated with a step-by-step process where, first of all, gross total income is determined and after which deductions are made to reach the total income. Thank you for your attention. I did my best in this discussion and this chapter.